in the Mayor Scottsdale Old Town here in Scottsdale, Arizona. It has been a minute since I have been able to come on here, and it was due to a horse riding accident. About a month ago, I was in California riding in the Hunter Jumpers, which I've done for almost 40 years. And on an easy warm-up day, I had a fluke accident and I fell off my horse and ended up in the emergency room with a broken humerus near my shoulder, a broken wrist, a very bruised up face. And after I was done with those injuries, I ended up back in the hospital with PE, or pulmonary embolism, and blood clots in my lungs. So it's been quite the journey, but I'm feeling better. I'm recovering. If you can see behind me, I have some of my horses that I've ridden over the years in the background. I love riding and I can't wait to get back on again. Okay, but about the market. We're going to take a look at the market at a national level and then also here at a local level as well. So let's jump on right into it. I saw this article online on CNN, and it says the housing market looks like a bubble, 2008 regulator says. So what do they mean by that? She actually doesn't, it's Sheila Blair, who had a front row seat to the subprime mortgage meltdown, is worried today's housing market is unsustainably hot. Okay, the median home price in an existing home stood at just $278,000 in August of 2019, according to the National Association of Realtors. The figure has since spiked to $407,100 as of August 2023. Talk about a bubble. That's a classic case of supply and demand imbalance. Okay, so you're thinking here, are they going to say that it's going to burst? The article actually doesn't go on to say that. And if I jump down here to say letting that bubble deflate, the 1-2 punch of surging home prices and high borrowing costs have made it very difficult for many Americans to afford to buy a home today. Despite the mortgage rate surging to over 7.49%, some cities are still experiencing rapid home price gains. And we'll get into Phoenix's here in a minute. But over the past year, the median home prices increased by 3.8% in Los Angeles, 18.2% in San Diego, 15% in Richmond, and 14.6% in Cincinnati, according to Realtor.com. Letting that bubble deflate a bit would probably be a good thing, said Bear. People who already own their home, and I'm one of them, don't want to hear that. But if those who want to own, I hope prices do come down. The good news, Bear says, she does not see a repeat of the bursting of the mid-2000s housing bubble, which has set the stage for the Great Recession. That's partly because a typical homeowner today has more equity in their homes than a homeowner during that time. Only 1.1 million homes, or 2% of all mortgaged properties, owed more on their mortgage than their home was worth in September, according to CoreLogic. That is a small number compared with the share of properties underwater during the subprime mortgage crisis, which topped out at 26% in the fourth quarter of 2009, according to CoreLogic's equity analysis, which began the third quarter of 2009. In addition, mortgage lending standards are significantly tougher today, meaning fewer people are borrowing more than they can afford. I see much less speculation in the housing market today, thank goodness, said Bear. And unlike the mid-2000s, homeowners today have built up significant cushion of equity. That means they shouldn't find themselves in a situation like during the subprime mortgage meltdown, where many owed more than their homes was worth. Even if home prices adjust a bit, people should not be underwater. So I hope that clarifies a little bit why now isn't the same as 2008. And let's jump into this prediction. This is on Bankrate, housing market predictions for 2024. So with mortgage rates and homes becoming both historically high and inventory tight, many prospective sellers are hopeful buyers are feeling nervous about today's housing market. I'm sorry. Many prospective sellers and hopeful buyers are feeling nervous about today's housing market. As of July of 2023, the median sales price for existing home in the U.S. was a steep $406,700, the highest July price the National Association of Realtors has ever recorded, and just $7,000 short of the all-time record. And as of late August, the average 38-year mortgage had hit 7.3%, 6%, higher than it's been in more than 20 years. So what will happen with the housing market in 2024? A lot depends on the mortgage rates. They roughly doubled in 2022, thanks in part to the Federal Reserve's war on inflation, and have stayed high ever since. While the Fed does not directly set mortgage rates, mortgage lenders take cues from them, and the mortgage rates climbed in tandem with the Fed's long string of rate hikes. The Fed's war on inflation may soon end, however, and rates could fall as a result. Rising productivity, coupled with tighter financial conditions and the slowdown in hiring and cooling of normal wage growth, are indicators that the Federal Reserve's campaign against inflation might soon be over. With inflation easing, many predict that the mortgage rates will slightly cool off next year, but buyers will continue to feel the squeeze. Core inflation is expected to remain above the Fed's target range of 2 to 2.5% going into 2024, says Chen Zhao, who leads the economics team at Redfin. For housing, that means the start of next year will be pretty similar to this year, with slightly lower but still elevated mortgage rates. Rates will still be high enough that buyers will still be challenged by affordability, and sellers will be reluctant to give up their low existing rates. Okay, will housing sales decline? While home prices have certainly held firm this year, the volume of home sales has softened considerably. Existing home sales in July of 2023 declined to an annual pace of 4.7 million homes, according to the NAR data, which represents 16.6% drop year over year. However, these trends may pivot in 2024 if mortgage rates dip as anticipating. Retreating mortgage rates will bring more buyers and sellers to the market and get Americans moving again, says NAR chief economist Lawrence Young. Lower mortgage rates would help spur home sales activity, which are expected to increase in 2024 compared to 2023, says Selma Hepp, chief economist of CoreLogic. Declining in mortgage rates will drive more sellers to trade their existing homes and help add much inventory to the market, leading to more transactions. Housing sales are expected to increase a bit from this year, says Zhao. However, she qualifies, we are not expecting sales to increase dramatically as rates are likely to remain above 6%. And according to Lawrence Young, there simply are not enough homes for sale, and the market will easily absorb a doubling of inventory. Will home prices go down? Home prices have been on fire lately, accumulating in historic highs. So home prices drop in 2024? Probably not, says Young. Home prices will rise about 3 to 4%, he predicts. So that's important as we're looking out there to think, is now a good time to buy? Interest rates are really high. And as we know, buying power has decreased and we're having an affordability problem. However, experts still think that we're going to go into 2024 and prices are still going to continue to increase. So if you can get into the home buying game as a first-time home buyer, maybe pay off your debt, see if you feel comfortable with your payment at the interest rates today, and see if you can start building some equity through homeownership. Okay, the Cromford report, and this is at a local level now, we're talking about Phoenix. So for much of the year, the new listing counts have been extremely low. So again, that supply and demand issue, often more than 40% below the same period in 2022. We saw somewhere between 6,500 and 7,500 new listings every 28 days between May 25th and October 2nd. Since October 3rd, we've been measuring slightly over 7,500 listings per 28 days. The normal level is 9,500 to 11,000. So we are still far from normal for this time of year, but not as far down as the last 4 months. So inventory has been increasing. The extra new listings are coming from just as demand takes longer to leg down, which means the active listing pool is getting more input and less output. You would therefore expect the active listing count to grow, and you would be correct. For all the areas, we saw 13,901 active listings without a contract on Saturday, up 13,432 a week earlier and 13,103 the week before that. With monthly annual sales continuing to drop, kept dropping, inventory measures such as monthly supply of inventory are increasing, but they were still well below normal. The competition among sellers is growing, and the buyers remain to have more of a choice. The market is softer than during the second and third quarters, and upward pressure on prices is dissipating. So what does that mean? If you're a seller, you need to be priced right. You need to be priced at or below market value, and your presentation needs to be on point. And I find that buyers in this market are really wanting turnkey properties, so properties that have been updated. So let's see month of supply on the market. So this tells a pretty good picture. So we're at 2.3 months of inventory on the market right now. Look at when we were really hot and we were down here in 2021 at 0.4 months of inventory. And then let's see, when we were in April of 2022, we had 0.5 months of inventory. And then we climbed all the way up here to 3.8 months of inventory. And then we came down in the spring when we gained back a lot of the value that we had lost during when the rates went up at this time last year. And now we are starting to gain with market days on market. So sellers who have more competition. Okay, so let's see. This is the Cromford Market Index. So as this moves towards the yellow, we're heading more towards a balanced market. As this number gets lower, we are going more towards buyers and less towards sellers. So sellers out there, gone are the times that you can put the sign in the ground and the house is going to sell. And buyers, they're facing an affordability problem. So it's important that you take a look at that and you price for today's market. Rates. So rates are doing slightly better. They're at 7.66% today for the 30-year fixed, and the 15 years at 7.1%. So we know that the 30-year fixed is tied to the 10-year yield. So right now the yield has come down. So we were higher. Let's see. I like to look at the day right now to kind of zoom in a little bit closer. See if it'll give me that. Okay. So we have come down a little bit to where we have been at. We were up closer to, let's see, 4.6750. We even went up to 4.7. I know about a day or two ago, and now we've come down to 4.619%. So the more that can come down, the better hope there is for the 30-year mortgage rate to come down, for the rates to come down. And let's see, why is that? Inflation is one of the main reasons that rates are as high as they are. If the data fails to show progress back toward more levels, rates won't come down. Today's data arguably showed the opposite of progress, particularly in the service sector. And this was yesterday because the CPI, Consumer Price Index report, had come out and it wasn't positive for rates coming down. The bond market, which dictates mortgage rates, began losing ground, which implies higher rates immediately following the release of the CPI data. Later in the day, the scheduled auction of the 30-year Treasury bonds was met with lackluster demand, thus pushing rates even higher. Now that was yesterday. They come down a little bit today. Okay, so as I've been saying, what's important when you're listing your house as a seller? Price and presentation are the two most important things. And product. So when I say product, I mean how turnkey is your home. Buyers right now, since they're facing an affordability issue, don't want to go into a house and have to fix it up. They don't, quite frankly, they don't have the funds to do that. So as a seller, or the homes that are selling faster are the ones that have updated kitchens, updated baths, flooring. Everything looks more similar to new construction. But if you're a seller, you're going, how can I, pay to afford that prior to putting my house on the market? Well, there's a great program. At Windermere, we have Windermere Ready Program 2 that we're getting ready to release in the Southwest region and here in Arizona. Until then, I have another program for you, and that's called Curbio. So Curbio uses the equity that you have in your home, and they charge you 0% interest and 0% upfront costs. And you're able to use a program like that to hire contractors. They have a project manager for you, and they're able to go in there and to fix your home and update it by using the equity that you have in your home. So it's really quite great. It's called Curbio.com, and I'll link it below this video. And you can go in there and ask for, get an estimate. You can sign now, as I was saying, and pay later. You can meet your project manager, and they have all licensed and bonded, of course, professionals that are ready to help you. So that's a great way to get your home presentable, updated, looking brand new. And ultimately, if you do that, you'll be able to net more for your home. So something to consider. Now I just like to touch on this just real briefly. Phoenix and water is such a hot topic. I'll link this below too. This is the Washington, I can't think, WSJ Journal, Wall Street Journal. I'm sorry, not Washington. That's where my brain goes, of course, because I'm from Washington. Anyway, sidebar. The Wall Street Journal has a great article that I'll link down below that just says Phoenix is in no danger of running out of water. Farmers in Arizona use far more of it than residents do, so demand declines as the population grows. So interesting fact about Phoenix, we use the same amount of water as we did in the 1950s. I'll link that article below, and I look forward to talking to you next time. Until then.